All right, so today is Thursday, April 18th. We're going to do a quick market overview and go over earnings season. First up, we've got the Nasdaq. On the left side, we have a weekly chart. In the middle, we've got the daily chart. And then on the right side over here, we have the 130-minute intraday chart. Each three of these bars is equal to one trading day. The trading day, I think, is 6.5 hours, 130 minutes to get three equal bars. That's why I've got it set up that way. All right, so to get into the Nasdaq, we're seeing continued selling today. We came just down to this 100-day moving average. The selling is now more intense in the Nasdaq than it is the S&P 500. We're sitting just on the 100-day in the Nasdaq. On the S&P 500, we're sitting between the 50-day and the 100-day. The 130-minute intraday chart on both the QQQ and the Nasdaq is starting to show oversold conditions. So over here on this RSI, on this last bar, we're showing a reading below 30 at 28.1. And then on the slow stochastic, we are showing two readings here below 20. Both of those are oversold conditions. So it's showing up here first on this intraday chart, which makes sense. This is a basically a final resolution on the time frame. The next place that will show up in is going to be the daily chart, followed by the weekly chart. So next, we're going to pull up the S&P 500 here. And as we look at the S&P 500, it is a very similar setup. Also, these moving averages that we're looking at here, this 20-day, the 10-day, the 50-day, this 100-day, they all correspond to the same moving averages across time frames that you're looking at here. So looking at the SPY, we've got the same setup as the Nasdaq, just not quite as oversold as much. Didn't come all the way down to this 100-day moving average here, but we've got the same oversold conditions here where we are looking at, and I'll actually blow this up so you can see this a little bit better, but we have the same oversold conditions here that we're looking at where we have the RSI sitting just at 30, so just at the oversold condition, and then our slow stochastics are both sitting underneath 20, so we're showing oversold conditions on both of these as well. Next up, we'll pull up the VIX. So this is going to be the volatility index for the S&P 500 index options. Sorry, I don't know why it's clicking back and forth like that. But basically with the VIX, what I want to show you here is the VIX is usually going to trade inverse of the market itself. So I'm going to zoom out to a very long monthly chart here. This moving average right here is the 11-and-a-quarter, 11-year moving average. So it sits at right at 1794. So when we're below the 1794 level, I know that we've got below average volatility. Once we start getting down here in this 12 range, usually I'm expecting some kind of market reversal or market turnaround just because the volatility is so low, and I'm expecting to tick up. And that's exactly what we saw here at the top of it. Basically, this is just kind of showing like the top of the market. And we have sensed, let me move back over here. So what we're seeing here is when we got down to this 12 level, this is basically like the top of the market right here in the Nasdaq and the S&P 500. Volatility kicks in, sell-off starts, and you see the volatility kick in, market sell-off. So this is just something that I pay attention to. Also, if you trade options, I pay close attention to the VIX too, because this is essentially showing you how expensive or inexpensive the premium on the option contracts are that you're trading. All right, so taking a look at gold here, we've got gold at all-time highs. I'll actually zoom this chart out so you can see a little bit better. So this is the monthly chart of gold. All-time highs was reached back in 2011 here. We kind of, tried to peak out above this range a couple times, but those weren't sustained breakouts and they failed. So as you can see, this most recent breakout, this 2084 level is really what, was the catalyst that really moved us higher. Once we broke out above this over here on this right side of the chart, this is when we were really off to the races in the gold markets. The demand behind gold right now is central banks. So central banks are, especially the BRICS, so that would be Brazil, Russia, India, China, South Africa, are trying to de-dollarize and get away from the dollar. A couple problems with what they're trying to do. Their currencies themselves aren't that liquid. Their currencies fluctuate a lot. Also, the interest rates on their currencies is kind of crap. So they're talking, the last thing I saw about the BRICS was they were talking about using crypto to trade internationally between themselves. And they're also buying up a ton of gold. So they're buying up a ton of gold, but the problem I have with gold, nations don't really trade with gold between their central banks. And it seems to be once you get gold in your central bank, you don't really let it go very often. But that is the demand moving gold higher. Next thing we're going to take a look at is going to be the 10-year Treasury yield. So the 10-year Treasury yield right here, I've got a chart pulled up. This goes all the way back to 1962, I believe. And so the rates in 1962 were just at about 3.8%, was kind of their low spot. Their high spot here is about 4%. So what I want to show you here is these rates that we've seen since the 2008 Great Financial Crisis, right over here in this area. These rates have been extremely low. Like, this is the lowest interest rates that we've seen basically in human history. I mean, they got all the way to the point where they're below 1% here. So, my thesis for a while has been there's nowhere for rates to go but up. We're now seeing that. I'm hearing a lot of people say, oh, interest rates are so high, everything's so expensive. No, historically, interest rates are not high. If anything, this is getting back to the low end of interest rates here. When people talk about hyperinflation, et cetera, et cetera, the inflation's so bad, blah, blah, blah. No, I mean, it is elevated. It's more than what we are used to in our adult lives. But back in the 80s, late 70s and the 80s, they actually had an inflation problem. And that's when Paul Volcker and the Fed, he hiked rates, I want to say 18%, close to 18%. So what we're seeing now, I mean, these rates are not expensive, but the one thing that we are seeing as the interest rate on our bonds continues to go up, it makes our currency more attractive versus other currencies. Next thing that we're going to take a look at here is the dollar index, and this is just showing the strengthening of the U.S. currency versus other major currencies. So the dollar has been strengthening, the other currencies are weakening. A lot of talk about dollars going to crap. The dollar's losing all of its value, blah, blah, blah. Relative to other currencies, that's not actually true. The dollar has been strengthening. Next thing that we're going to take a look at here is copper. So with copper, we have the electrification of everything. EVs are coming online across the world. China is a massive market for EVs, along with Europe and the US. So as more people buy EVs, we're going to need more copper for the EVs themselves. We need more copper for the charging stations. We need more copper to distribute electricity across the grid. Our transmission capacity needs to be upgraded. There's a lot of the AI data center boom that requires copper. So there's a huge tailwind behind the metal itself. And the all-time high for copper is right over here at 503, and we're currently at 443. So making a march towards those all-time highs over here in the copper market. All right. Next, we will pull up Bitcoin. So Bitcoin is just below its all-time high here that just recently set at $74,415. It's sitting just on top of its 50-day moving average, but I do want to say something that what we're looking at right here, this is the Bitcoin futures market. This is not the actual Bitcoin. Like, if you pull up a chart of the cryptocurrency itself that trades 24/7, that chart would look a little bit different than this. I'm sure the moving averages would be a little bit different. Those trade 24/7. The futures market does not trade 24/7. It's definitely closed on Saturday, opens up on Sunday, and closes on Friday. So just a little difference there, but I like this just because I can access it from inside of Thinkorswim. Also, if I'm trying to play this with options, I'd probably be in the IBIT ETF, which I've been waiting for a long time for the spot ETFs to come to the marketplace. They finally come to the marketplace. They're liquid. So if you're looking to play Bitcoin, the IBIT is where I would go for that. But basically, sitting right here on top of this 50-day moving average, which is what we're seeing with a lot of the indexes and a lot of the leading stocks right now. Next up, we will pull up Ethereum. This is also a futures contract in the futures market here. So very similar with Ethereum, sitting just below its 50-day, above its 100-day, so not performing as well as Bitcoin. Also didn't break out to a new all-time high, but I am bullish on the Ethereum ecosystem itself. All right, next up we have natural gas. I'm going to switch over to this really long-term monthly chart here on natural gas. As you can see, natural gas is absolutely dirt cheap, sitting here basically around all-time lows. We have an absolute glut of natural gas due to our fracking technology. We have ample gas reserves over here in America. Same cannot be said for the rest of the world. They don't have our fracking technology. When we look over at Europe, Germany is really suffering. They have a huge industrial base, but they get all of their, a lot of their energy was imported from Russia, which they've since sanctioned Russia. They're not getting energy from that natural gas energy from Russia anymore. So it's really, has caused their cost of energy to go up. In addition to that, they're importing liquefied natural gas from us and other sources, but that's just not as efficient as getting it from the pipeline, the gas pipeline directly from Russia. It's less efficient. Basically, they have to compress the natural gas into a liquid, put it on a tanker, ship it across the ocean, and then import it at their import terminals. So just not as efficient, but this is an advantage that America holds. We have dirt cheap natural gas energy in this country, and it is great. Next thing that we're going to take a look at are going to be a couple of international tickers for international stock markets. The first one, this is an ETF for Japan. Japan and India are the only countries right now that have stock markets at new all-time highs. Everybody else is middling, either lower or just slightly sideways, or kind of near the top range of their channel. But Japan and India, these are the two countries that are performing pretty well, just like America. India, they've got some good growth potential over there. They've got, a billion plus people. They don't have China's one child policy problem. So they don't have that messed up demographic where it's a bunch of old people and not enough young people to come in and replace them. They also don't have the female to male imbalance that China has. They don't have China's house of cards with the real estate market where they have a completely overbuilt residential real estate market where they have too many homes built for the amount of people that they have in their population. So I am bullish on India long term. They are a capitalist society. They are also democratic. There's a lot of bureaucratic red tape to do business in India, but Modi is working on reducing that bureaucratic red tape and really welcoming investment into the country. They also account for about 30% of the world's semiconductor staff. So those semiconductor engineers, a lot of them reside in India. So India is pretty, in my opinion, pretty well positioned moving into the future. All right, next thing that we're going to take a look at here is going to be the earnings that have come in so far in earnings season. All right, so taking a look at the earnings so far that have come in this season. First up, we have JP Morgan with the banks. They reported Friday before the open. They had a top and bottom line beat, but the stock did sell off along with the broader markets. On Friday was the day when the Nasdaq and the S&P 500 sliced through their 50-day moving average. I'm assuming that this just got taken out, with everything else. Rising tide lifts all boats. And when the indexes are selling off, all boats are going to sink with the tide. So I think that's kind of what was going on here with JP Morgan. It looks like it's kind of stabilized since then, but still below a declining 5-day moving average. Next up, we have Bank of America. Bank of America, they also beat on their top and bottom line. They sold off along with the broader markets, but since then they have been recovering. So this is where the stock was before they reported earnings. Sold off here, tried to rally up in the morning, but sold off along with the broader markets. And since then, we've rallied back to basically just where we were before they had reported earnings this day. And then let's take a look at their actual earnings reports here. So this is JP Morgan, beats on both top and bottom line. You had an earnings surprise, revenue surprise. Taking a look here at Bank of America, same deal. We've got top and bottom line beats and both surprises on both as well. Next thing that we're going to take a look at here is going to be Interactive Brokers. They missed the streets. Whisper number, but they beat the consensus estimate. They also smashed the rest revenue estimate, and the stock rallied after this. So you can see here the revenue estimate was 1.17 billion. They did 2.2 billion. So pretty big beat there on revenue. And then pulling up the actual stock chart for Interactive Brokers. Just waiting for this to load here. All right, so with the Interactive Brokers stock chart, you can see here they sold down to the 50-day moving average along with the markets on the 16th, and then reported and then opened up yesterday on the 17th, and we had this big gap up here. So Wall Street likes their earnings. This stock is holding up very well compared to the broader market. As you can see here, we're just below the 20-day, but still sitting above the 50-day, whereas looking at the S&P and the Nasdaq, both below their 50 days. So this is holding up much better than the broader market. Next up, we have ASML. This is the Dutch This is the Dutch monopoly on semiconductor manufacturing equipment. So with ASML, they beat on revenue, but they missed on the earnings whisper number. They also lowered their Q2 guidance. So when it comes to earnings, you know, ideally what you want to see is top line beat, bottom line beat, and a raise on guidance. Forward guidance you want to see raised. So I've seen plenty of companies that they'll blow it out of the water for top line and bottom line, and their earnings, earnings per share, they'll blow all that out of the water. But if their revenue guidance is in line or if it's negative, the stock can sell off. Wall Street is very forward looking. It's not about what you did for me, it's about where we're going. I'm not concerned about ASML missing on their expectations. A lot of that was due to China. There are restrictions on what they can sell to China, but the broader market should pick up the slack. They didn't change their overall outlook for the entire year. So for the entire 2024, they didn't change their outlook, but they did, cite some forward weakness. A lot of that has to do with the fact that they are on technology restriction export lists. Their leading products are, so they can't sell them to China. And China is a very big market for their semiconductor products. But I do expect the Western nations of Europe, uh, the European nations, America, and then our allies in the East, Japan, South Korea, I do expect us to be able to pick up the slack for that. There's huge demand for building these chips outside of Taiwan and South Korea. There's regional risks there. So a lot of European and our American government are throwing subsidies, government subsidies, to incentivize these chip factories to be built outside of South Korea and Taiwan. Next up, we have Taiwan Semiconductor. Taiwan Semiconductor had a top line and a bottom line beat. The stock sold off with the broader tech sector today. They lowered their forward guidance on semiconductor market growth just to 10%. Previously, their guidance was more than 10% semiconductor market growth. So they've changed that from more than 10% to just 10%. So I suspect that this is one of the reasons why when we look at Taiwan Semiconductor, we got this gap down, we had a little bit of a sell-off, but this also has to do with the tech sector getting thrown out, QQQ having a pretty big down day today, all the way down to its 100-day moving average. It is a stock I like, but with this stock, you have to be aware that there is regional and geopolitical risk. If China chooses to invade Taiwan, I imagine that this stock would crash very, very hard, very, very quickly. But with that said, I also expect the tech sector overall to crash very hard, very quickly if China were to invade before we could get meaningful chip production capacity outside of Taiwan. So we'll see with that. Just a word of caution with Taiwan Semiconductor, there is geopolitical risk with that stock. Next up, we have Netflix. So with Netflix here, nope, we've got ISRG actually. So with ISRG, they had top and bottom line beats. The stock sold off with the broader tech sector today. Intuitive Surgical, they produced the Da Vinci robot system, so it allows surgeons to come in and do minimally invasive surgeries instead of having to cut you open the old way, make a really large incision, pull your skin back, and then go and work on you that way. Instead, they make very small incisions, and then the robot goes through those incisions, and the surgeons do the operation through laparoscopics. Intuitive Surgical, this is one of the stocks that I've liked for a while in the medical space. And I will also zoom out here, show you their long time stock chart, and then we'll come back in here and take a look at Intuitive Surgical. I believe that they reported today after close. So let me just swap over here to our intraday and see what they have done on the intraday chart. This is a 30-minute chart. So each one of these bars is 30 minutes, and these highlighted areas are the extended after hours trading. So as we can see, this stock has rallied after reporting. And then we'll also pull up Netflix. All right, so Netflix, they reported today. Gonna have to pull the ticker up here. They had both top and bottom line beats. The second quarter guidance was above consensus for earnings, but below for revenue. And it looks like they are selling off after hours. So as we can see here, beat on revenue, beat on earnings. Surprises on both here. But when we take a look at their after hours, they are selling off after hours. We did get a little spike here, but this continues to sell off. I imagine this is just selling off with the rest of the broader tech index of the Nasdaq. All right, now we're going to shift gears here, and we are going to take a look at the market leaders who are holding up very well in this market environment. First up, we have Google. They're one of the hyperscalers. They recently had their AI day. Investors really liked what they said at their AI conference. This stock is above. It's sitting, just above its 10-day moving average right here on this daily chart. Also, you can see a little bit better here on this intraday chart, well above the 20-day. Well above this 50-day and 100-day moving average. So this right here, the reason why I'm pointing this out, when the market does turn and the bear market gets done, or the correction or the sell-off, this temporary sell-off that we have, when this gets done, typically the leaders who held up really well tend to be the leaders in that next bull cycle. So this is why I'm keeping my eye very closely on what stocks are holding up very well in the sell-off. Next up, we have Facebook. Facebook, once again, this stock is sitting just above its 50-day moving average, but the thing to look at here, this was their last earnings date, gapped up here, never gave up this gap. We never filled in this gap. We're sitting here at all-time highs on Facebook, or I guess you could call them Meta now. But the important thing to note here is this did not come down to the 50-day moving average. The 50-day moving average has come up to where the stock is. So this is bullish. This is another one of the AI hyperscalers holding up very well in this marketplace. Next up, we have GigaCloud Technologies. GigaCloud Technologies specializes in moving large packages in and out of China. And basically they handle like the warehouse space to deal with that and logistics. This chart here looks a little crazy. Let me zoom this in here. Okay, so this is what GigaCloud Technologies chart was. It was a previous company under some different ticker. So this is what the chart actually looks like. This has been pretty bullish, and as you can see here, this chart is holding up well above its 10-day moving average and also above its 50-day moving average. Next up, we have Republic. I believe this is Republic Services. Republic Services, they're in the waste management business. Once again, 50-day moving averages coming up to the stock. We're sitting here at these muddled 10-day and 20-day moving averages, but this isn't selling off and going down to 50. The 50 is coming up to this. So this, once again, another bullish stock that we're looking at. Here we've got Sprouts Farmers Market, same deal. 50-day moving averages coming up to the stock. We're sitting here with these muddled 10 and 20-day moving averages, holding up much better than the broader market. We're not seeing a steep sell-off yet in this stock. GoDaddy. So I'm going to switch over to this long-term monthly chart here on GoDaddy so we can take a look and see kind of what GoDaddy has been doing over time. So looking at this GoDaddy chart, from all the way back here in 2018 all the way till the end of 2023, this stock was sideways range bound. We're just in this channeling. These Bollinger Bands have narrowed in. We're channeled, and we're just channeling through here. So we've got 3 years of built up, pent up energy in this that has just broken out. This is off to all-time highs. This is also playing on the AI kind of I guess you could say data storage space. They provide web hosting services. And once again, just under this 20-day moving average, we're not selling at this point yet down to the 50-day. The 50-day continues to rise up to where the stock price is. This is looking pretty good. Next up, we've got Pure Storage. This is another data storage play. Pure Storage, same deal. Muddled 10-day and 20-day moving averages over here. We're just hanging out. We're not really selling off. We're not selling hard. 50-day moving averages coming up to meet it. One of my favorite stocks, we have Eaton Corp up next. Eaton, they are an industrial electric component supplier. So like I said, with the electrification of the grid, AI data center demand, all of these different things, Eaton is well capitalized to make money on this. They are, I want to say like a year back order on their electrical products. So like if you're building a new building, want to connect to the grid, you're waiting like a year for their products to be able to connect your building to the grid and distribute the electricity inside that building. Once again, sitting just below this 20-day moving average. The 50 has been coming up to meet the stock. This hasn't been selling off down to the 50-day moving average. And the last one we have here is Core & Main. They are industrial water services providers, so pipes, things that you would need at like your water filtration plant. That's what they specialize in. Another industrial play. Pretty bullish on this one as well. As we can see here, we're selling below the 10-day and the 20-day. The 20-day is flattened out. We have a declining 10-day, but we're above a rising 50-day moving average. So that's all I got for you today. Just continue to be patient. Let these markets kind of do what they're doing. To go back to the broader indexes here, I'm going to pull the QQQ back up. Taking a look at the QQQ, like I said, we're getting these oversold readings right here. It's not a time to do anything or anything like that. Just be patient. Really kind of waiting to see some sideways price action here in the Nasdaq. But so far, earnings have been coming in pretty good. I suspect that this can be a catalyst to get the market going higher again. But maybe the big money managers, maybe they have a difference of opinion and they want to let the market grind sideways for maybe a quarter or so, let the market catch its breath. But yeah, that's where we're at right now. So just be patient, have your watch list ready, and be ready to buy some of these, high quality growth stocks on the dip instead of buying at all-time highs. The market sell-off is the time to get your shopping list ready, and it's the time to buy your favorite stocks on a discount. That's all I got for today. Report back to y'all later.